Imagine this. It's January 2010. You start investing just $100 a month, the cost of a gym membership, a few takeout meals, or your monthly data plan. Fast forward to today, and that simple habit, just $100 every month, could have turned into over $35,000. No day trading, no complex strategies, just patience, consistency, and the magic of compound growth. So what if you had started in 2010? More importantly, what if you start today? Let's break it down. Simply, visually, and beginner-friendly. Welcome to Investment Chats, your go-to channel for smart money moves, especially if you're just starting your financial journey. Today we're diving into a powerful question. What if you invested just $100 a month starting in 2010? You don't need a lot of money to start investing. You just need time, consistency, and a bit of curiosity. And this example will show you just how far small amounts can take you. But first, let's set some ground rules. We're assuming you invested $100 every single month since January 2010, chose a popular index fund like the S&P 500, left your money alone to grow, no buying, no selling, no stress. Now, why the S&P 500? Well, it's basically a group of 500 of the biggest companies in the U.S. Names you know like Apple, Microsoft, Coca-Cola, and Amazon. It's like owning a tiny piece of the whole economy. Historically, the S&P 500 returns about 10% per year on average, though that includes good years and bad ones. And yes, there were dips, crashes, and recoveries along the way. But the important thing is, you stayed consistent and never stopped. So by the end of the first year, 2010, you've invested $1,200. After a few years, you're at $6,000 invested. But thanks to market growth, it's not just sitting there. It's growing, quietly but powerfully. Let's fast forward a bit. By 2015, you've invested a total of $6,000. But your account could be worth about $8,500. That's a return of over 40% without lifting a finger. Now skip to 2020. You've invested $12,000 total, but with the market's rise, especially during the post-COVID bounce, your balance could be over $21,000. And finally, 2024, you've put in $17,000 in total. And guess what? Your account could now be worth more than $37,000. That's more than double your contributions. This is the power of what's called compound interest. Your money starts making money, and then that money makes more money. Over time, it snowballs. So here's the big picture. You invested $17,000 total, and thanks to time and compound growth, you've got more than $37,000. That's over $20,000 in pure growth. Not from working more, not from guessing the market, but simply from showing up every month with $100. And here's the kicker. It didn't matter that the market dropped in 2020 during the pandemic or dipped in 2022 due to inflation. You kept going. You trusted the process. You played the long game, and the results speak for themselves. Lessons you can take away. 1, timing. People always ask, when's the best time to invest? Truth is, the best time was yesterday. The next best time? Today. You don't need to predict the market. You just need to be in it. 2, consistency is everything. It's not about how much you start with. It's about how often you show up. $100 a month may not sound like much, but over time, it builds a habit and a future. 3, small money grows big. You don't need thousands of dollars to start. Start small, grow slow, stay consistent. That's how wealth is built. How you can start today, even if you're a beginner. So how do you actually do this? Step 1, pick a simple investment app or brokerage. Look for beginner-friendly platforms like Fidelity, M1 Finance, Robinhood, or Vanguard. Step 2, choose an index fund. If you want to mimic this exact example, go for something like VOO, tracks the S&P 500 SPY, another great S&P 500 ETF. These funds give you instant diversification, meaning your money is spread across hundreds of top companies. Step 3. Set up auto investing. Link your bank account, set it to automatically invest $100 a month, and forget about it. You don't need to time the market. Just let time do the work. Step 4. Leave it alone. This is the hardest part. Don't panic when the market dips. That's normal. The key is to stay in the game and let the long-term trend do the heavy lifting. The best investors aren't the smartest. They're the ones who started early, stayed consistent, and never stopped. So ask yourself, what could a 100-month today become by 2035? By 2040? You don't need a finance degree to build wealth. You just need to start now and keep showing up. If this video helped you, hit that like button, subscribe for more beginner-friendly investing content, and drop a comment. If you started investing today, what's your goal for 10 years from now? Let's build this community, one smart choice at a time. Thanks for watching Investment Chats, where small moves lead to big futures.